Much for joining today. I'm Natalie Levy, the founder of She's Independent. And today we're really going to be focusing on investments. And the She's Independent Investments business is something we actually kicked off formally just recently, this January. And the topic of angel investing is something that I love talking about. I would say that I kind of got pushed into launching the investment group in a very positive way because I have an investment background. I started my career on Wall Street trading derivatives, spent years in various tech operational roles, but still was investing, via angel groups, and then also spent some time in the private equity side out in San Francisco. By no means is investing something where you can say, you're always going to have tremendous returns. But just as an example, I've had some really tremendous returns on my early investments, where the average return on my first 4 investments, I've had liquidity or liquidity options on 3 of those. The average return is over 20 times. So it's kind of obscene. That being said, it's something risky. We'll talk about it. But anyway, She's Independent Investments. It's a group of, we're about 40 members at the moment. And we're really all about learning and access and, getting people involved in building this skill set and then also participating, whether it's on the investment and financing side or stepping into strategic roles, mapping a path to the boardroom. A lot of really great things we can do in terms of power dynamics there. We'll get a little bit more into that. I wanted to first share a little bit more about myself since I'm presenting today and I'd started the initiative. And it's just a minute to kind of spend thinking about your why. And my why is a really deep one. It's with She's Independent, I wanted to start a business that really kind of honored and supported and, worked with women in various capacities because we'd lost my mom in a really tough way. Growing up, she really supported me and I had to fight for different roles and different opportunities through my professional career. And it was never easy to find or, almost impossible to find that mentorship and that guidance, to really build up to the bigger roles that I wanted. And plenty of Me Too moments in there. There's just a few kind of pictures here to share a little bit of the story, but it's really created and given me this drive and this really impactful why, so that I'm mission driven. I'm so excited. I couldn't be more passionate about working with other women and, saying, what can we do to really promote diversity and gender equity, and just get more people involved in a world that for too long has been dominated by kind of a certain type of person that doesn't necessarily look like us. So really excited to be here. I'll share more about it, but moving over to the agenda, we have a lot to cover today and we can't cover everything, but a lot of really good content and topics to get you thinking about angel investing. We're going to talk about the fundamentals, the framework. What is angel investing? How is it different than other types of investing? Again, not going to cover everything, but we'll start to give you a picture. We'll cover the fundamentals of, and what is a typical deal cycle? What do we look for? Again, too much to cover, in one session, but we'll start to do that. Why should you start thinking like an investor? There are a lot of reasons, power dynamics being one, but want to make sure that you're mapping a path, in terms of your career, in terms of equity comp packages, maybe that you're stepping into that are really meaningful and that you can be intentional around. And if you don't understand this stuff, you can't negotiate, right? And then finally, we'll close on how to get started. And you do not need to be an accredited investor or wealthy individual to start thinking like and participating like an investor. One more slide on, kind of the state of the world today. And these are numbers that are a little dated. And, I think in ways, it just starts to give you an idea of the inequity. But in 2020, women were earning 83 cents on the dollar earned by their male counterpart. And that's women more generally, but women of color far worse. Similarly, there was only 3% or less than 3% of the venture financing going to women-owned businesses. Again, women of color, far worse. Black women, I know it was under 0.5%. Makes no sense. Representation on executive teams, representation on boards, right? There's a lot of inequity across the board. And so we're really excited to be able to come together, skill and work and create this ecosystem. So ultimately we can add to the growing ranks of power players, get more women identifying and diverse audiences into these roles that really have a huge impact. All right. So what is investing? What is angel investing? There's all different forms of investments out there. At a high level, you're probably very familiar with or somewhat familiar with public markets. You heard, ooh, Tesla and Elon Musk are doing this thing. I want to buy a stock or a share in, Tesla. You can trade in public markets many different assets or many different, stocks or companies that you want to either buy or sell or get exposure to through some other vehicle like options. What we're going to be focusing on today is private companies. We're going to be talking about angel investing, which is one of the stages of financing or fundraising that happens when a private company is getting money. If you're public, that means you went to the public markets and you basically IPO'd and it's tradable and accessible by a whole huge amount of people. And there's a lot more transparency. Private markets are a different animal. Private markets are, again, you can participate, but there might be illiquidity and there might be higher risk and less transparency. But private markets and private companies, it's a different way to invest. And angel investing is a form of investing in private companies. There are different instruments when you invest. There's equity and there's debt. There's different forms, and we could talk about a bunch of different forms of debt, and we actually will talk a little bit about that later. But there are different ways to take exposure or basically place or have an investment. The other way to think about angel investing is when you're in private markets, there are different ways to get exposure or to invest in private markets. Angel investing is a direct investment, meaning I, Natalie Levy, or She's Independent Investments, LLC, is investing in this company. And so I have maybe raised my hand and said, yes, I'm signing off. I invest in this company. I'm signing all the documentation, the terms of the raise, or maybe the angel group is, but I am making a decision that I want to invest in that company. It's a direct investment. If I go through a fund, so I know there's a lot of venture funds out there. There's a lot of people that say, hey, I have a great track record. Give me money. And you are not determining which companies you want to invest in. They are, and you're giving them money or you're giving them capital. That's indirect investing. So again, the takeaway is direct investing. You are directing, right, where those funds are going. And in an angel group, often, I guess they all can operate a little bit differently, but in our angel group, it's what do you want to invest in? And you can say, great, I want to invest in that company. I want to pass. I don't want to invest in that company. And you have a say. You have some autonomy. Let's talk a little bit about the ecosystem. So I mentioned angel investing is a form of fundraising or financing that will happen potentially, within a private company. But what are the stages? If a company is fundraising, chooses to fundraise, meaning needs capital from outside investors, there are typically different stages they'll go through. Friends, family, and angels are typically first. Angels may participate at later rounds. An angel may say, I'm focused on pre-revenue, early stage growth businesses. Or an angel may say, you know what? I'm playing where they've de-risked some. I want $1 million of revenues and I want to invest there. So angels can play at different stages. But typically, angel investing and earlier stage investing, it's friends, family, angels, and these rounds that are seed plus maybe A, B, C, and they get incrementally bigger in terms of typically check sizes and the valuations of what they're raising. And again, angels can play in various stages of that. Why might angels play on the earlier spectrum of the fundraise? And by the way, I know I'm speaking, but questions, comments, feedback, drop them in the chat. You can come off mute, interactive, right? So I'm happy to answer some Q&A. If you have a question, I guarantee you somebody else has the question. So feel free if you have any questions. But why might angels or smaller investors like myself? I don't have, many millions of dollars, but I have enough capital where I'm excited to invest. Why might I want to invest early? I'll give you a scenario. I invest in a company and it's worth $10 million when I invest. and that company sells for $100 million. Assuming that, and I realize that there's a lot of detail I could share here, assuming that the portion that I invested in does not dilute, meaning they don't do a bunch of fundraising after that, and assuming that there's different mechanisms that can occur, but let's just assume that I'm getting a 10x return on that investment. So if I put in $10,000, then I make $100,000, 10x on the 10,000. But if I invested when they were worth 50 million and they exit at 100, I only have a 2x because it's going from 50 million to 100 million. So the earlier you can invest, it's riskier, right? But you can have this expansion or this bigger return that's happening because of the multiple, because of the valuation increase. And listen, if I'm not writing massive checks, and some angels will, but if I'm writing, moderate checks or smaller checks as an angel, you're not going to get much exposure if it's worth 50 million. But if it's worth 5 million or 2 million or 10 million, you're going to get more exposure. Okay. So types of financing.
So quick question, Natalie. Quick question.
Please.
Sorry. Yeah.
Please.
So it sounds like it's kind of the retail thing. You sell more at a cheaper price. The margins are smaller, but over time you make more. So is it a choice strategy to do lots of small investments with the hopes that something will take off versus?
That's a great question.
And you get what I'm saying. So
yeah, no, it's a great question.
Fewer at a bigger, and then you've got more risk and fewer buckets.
Yeah, I'll say a few things. From a portfolio theory standpoint, you don't want all of your eggs in one basket, meaning you want diversification and you're going to assume that these are risky. And so the back of the envelope statement that I've heard over the years is maybe you want 20 investments or more than 10 or 15 investments because these are risky and you expect that a lot of them are going to go to zero, maybe sideways, not really do anything. And so you're hoping that one or two will maybe do good things and that carries or, makes up for the rest of them. However, if you are doing a bunch of small checks, really small checks, it's accounting, it's, can you add value? Can you make intros? Because really, at the end of the day, if you're an angel, it's not just about, oh, I'm an angel investor. Can I add value to these businesses? Do they want me as an angel? And there are different things that we do, for example, in our investment group where maybe we're placing candidates, as advisory or board members, or maybe we're making introductions or referrals to others who may also invest or may, invest in their services. But you want to ask yourself, is this a company you can get behind? Is this a team you can get behind? And then can you add value? And it's okay if you don't always, but staying on top of 50 investments is a lot harder than staying on top of 20. But again, you don't want to, allocate or just invest in one or two companies because you want more diversification. But maybe you're planning to invest over the next 5 or 10 years. And so then saying, oh, if I want a portfolio of 20 investments over the next 10 years, maybe I want to be thinking about 2 a year. It's not like you're going to create it, today. We have a really good question in the chat, which says, can I write a check for $1,000? Typically, angel investors are writing checks that are $25,000, $50,000, maybe even $100,000. But an angel investing group can come together, and so we can lower that minimum. So a lot of the deals that we're playing in, we're offering $2,500 as the minimum investment check size. But we can bring it down to $1,000 if there's enough interest at that level. Great question. Now, we'll get more into this, but I just want to mention it since we're talking numbers. To make investments as an angel investor, you actually have to have the accredited investor status. To be an accredited investor, you can read the definition on the SEC website, the Securities Exchange Commission website, but basically it has a definition of you as an individual or you as a married couple or household. And it's based on annual income over the last 2 years or your net worth minus your primary residence. And not everybody is ready to invest, and that's okay, right? These are very risky. These are liquid investments, but you can still participate in terms of the learning. You can still plug in and start learning through, how is this angel group actually allocating? What would you invest in if you wanted to invest? But there are these really strict guidelines. Okay, one more point on this slide, which was basically investors and players, and I've highlighted or bolded what's your focus. And I think this follows really well on Mary's question, or my answer to Mary, which was, when you're thinking about investing, how many, allocations do you want to make? Where do you want to invest? So a lot of investors will say, if they've fundraised and they have money from investors, they actually have a mission and they have a very clear, investing guidelines. We focus on this and we invest in this type of stage. Angel, it's a little bit different because we don't have a mandate because we're the investors. We haven't raised from other investors. And so we may have a focus like seed, pre-seed, small A rounds, but we have the ability to decide how we want to allocate. But we still have maybe expertise or things that we look for, maybe mission driven or, a certain culture or a certain addressable market that can be really sizable on an exit. So having an understanding, what is your niche? What is your focus? Where can you add value? It can take years, many years, a lifetime, right, to figure that out. But starting to understand, I'm in medicine and I'm going to look at health tech or biotech or, this thing because you have that background, amazing. So matching your skills and matching, what industry's experience you have to the investment class or to that company, it's really interesting because then you can start digging in. But again, going back to when you're investing alongside others, it doesn't just have to be all your expertise. It can be the collective expertise. All right, so let's move on and talk a little bit about types of investments. I say type of private investments, and I'm actually more so kind of honing in on or speaking to when you think about investing in a private company, but these are also things or instruments, financial instruments that you could use to invest in some public markets as well. So I'm going to share in the context of private investments, but again, shares, options, right? These things also trade on public exchanges. But what are they? Shares, share count. You're working at a company and they say, we're going to give you 10,000 shares. What does that mean? Kind of nothing, right? What's the percentage of the business? But it's a way that you can talk about. These are the shares outstanding. Options, the right to purchase shares. So both of those are basically shares or equity exposure, just different terms and different nomenclature. And there's a mechanism to make them both shares or make them both equity, but those are both equity. And oftentimes you're hearing companies talk in terms of shares or options. Investment groups may be a little bit different. Why? We can talk about it. But a lot of investment groups, or the ways that angel groups or angels might invest in some of these earlier rounds, it might not be a priced round. It may be a convertible note or a SAFE, which basically says, okay, we're going to give you terms on this investment and it's going to price based on the next valuation. Maybe there's a valuation cap. Again, ask questions. But what I'm basically saying is, we're giving you in this round the maximum valuation of a $10 million cap or 20% discount to the next price round or next A raise or B raise. So there's different terms embedded, but the point is a convertible note or a SAFE note, which is a form of convertible. These are debt instruments that basically are converting based on, what happens given the terms and then how the next raise goes. And it's just an instrument that a lot of investors, or I should say companies, use in fundraising. And there are also price rounds. Hey, we're raising at a 30 million valuation or a 10 million valuation. And this is the percentage of the business that you will get, for putting in this much capital. It's a little more straightforward. Again, you don't have to be an expert in this stuff, especially if you're investing alongside others, right? Because you can ask the questions, you can make sure that somebody who has the institutional or the financial knowledge is really negotiating the terms that are advantageous. So we have a good question in the chat. Mary asked, with options, are you able to purchase at a special price? So an option is going to have what's called a strike price. And so an option is going to say, you have the right to purchase shares at this strike price. And that is a special price, I guess, assuming valuations go up. So here's an example for you. I worked at a company. I negotiated a really good equity comp package. And even though they ended up raising rounds, pretty big financing rounds, I had a decent amount that I owned of the options. When I left that employer, I exercised the options. So I paid something to own the shares at the advantageous strike price that they gave me. And then years later, when there was a liquidity event, or when that company further fundraised and then ultimately was acquired, I was paid out on the shares of ownership. If you don't exercise the options, there's usually a timeline, maybe 90 days or 180 days, then you lose ownership. Read the fine print, right? As an investor, which is different than an individual employee who's negotiating company equity, as an investor, when you write that check, you're not losing ownership. I love that deal. If you're an investor, you're immediately vested, you immediately have ownership. But if you are an employee of a company, let me repeat this, and you negotiate an equity comp package and they give you options, you have to both vest and basically get ownership over time by working with that company, assuming there's a cliff and a vesting schedule. And then you also have to pay something to exercise to own. We're going to cover this point a little bit again later. And again, this is not going to teach you everything, but it starts to share, right? It starts to get you thinking about these concepts. So when you're thinking about equity ownership, and we already talked about some of these, concepts, do you need to be an accredited investor? To write a check in an investment, yes. But to negotiate and to own equity through your employer, you do not need to be accredited. And to exercise options, right? When you leave that employer, you do not need to be accredited. So you can already start building a portfolio, building, equity ownership, even if you're not accredited. What's another path? You could be an advisor or board member and get equity ownership. And you could negotiate probably quicker, vesting and better terms versus just being an employee of the company. All right, my next point on the slide, and we're going to dig into this next, but how do you think about evaluation? It's kind of made up. It's based on supply and demand. It's based on what are people willing to pay for it. Has anyone heard about crypto kitties or crypto kittens? I remember hearing about them years ago, before all the craziness of crypto and NFTs and everything. But I was like, people are paying what? Basically, if somebody says, I'm going to pay $100,000 or $1 million for this NFT or this piece of art that's digital, exists on the blockchain, that's the market, right? It's whatever people will pay. The tip I have on the slide and the picture I have on the slide, the image is, check out Crunchbase. You don't always hear what was the valuation of the latest round, but sometimes you do. So if you're going to join an employer or you're curious about a company, what if they fundraised? How much have they raised? Can you see, publicly what were those funding rounds valued at? If you're navigating or, looking at working with an employer and they're giving you an options package, ask the questions. What was your last valuation? When did you raise? You want to, educate yourself on things like looking through Crunchbase, but you want to have that conversation. You want to dig in. The last point on the slide is learn through doing, because there's nothing like learning by doing, by actually taking some risk or, spending the time to educate yourself. And I love that investment groups, whether it's an alumni group or, friends and family, or, you check out She's Independent Investments, you can learn alongside others. So collectively, you're, running diligence, digging in, coming up with thoughts on what are the risks, what are the gaps, what do we think of the founding team? Another slide on this, what drives evaluation? Because I think this is something that's so opaque, right? It's this gray market. What is evaluation? And valuations really are somewhat meaningless when you really dig into them. It's, based on something. It could be based on market comps, meaning maybe I'm a private company in cybersecurity and there's a company that's publicly traded. And so that might dictate my valuation because we're in a very similar segment of cybersecurity. Or it could just be based on, hey, there's a bunch of interest in crypto and, the whole asset class is inflated or deflated or doing whatever it's doing. But it really, at the end of the day, is investor, interest and demand. And I have up a picture of a tulip, and, I mentioned Tulip Mania because there's a lot of times we never really know what the valuation is, right? Again, it's based on supply and demand, but there's this concept of bubbles that happen all the time. Real estate bubbles, real estate cyclical, asset bubbles. Sometimes there's more liquidity, sometimes there's less. You're probably hearing the Fed, pumped all this money into the economy and, inflation was crazy. This all can impact valuations. Tulip Mania was basically this concept, or the first known, asset bubble, or yeah, I guess it was an asset bubble, where basically the price of tulip bulbs went through the roof because it was just such a popular thing to own, to have, to trade. And then it went basically to zero. But, the idea that anything can be overinflated, it's really just based on supply and demand. Think about momentum and timelines. So let's talk a little bit more about angel versus venture investing, because, I think this is something where I feel really strongly, and I love, working with and empowering other women to say, great, you want to think like an investor? Don't just give your money to an advisor. And I'm not saying, by the way, that angel investing is for everyone. I'm never saying that. But by making decisions or being a part of where you want to allocate capital, you're not only gaining confidence, but you're able to invest with impact or invest in a way that's aligned with what you want, your mission, your goals, cultures you care about, people you care about. And again, the ultimate decision of, do you want to invest in risky assets? That's not something I will tell you to do ever. But the amount that you can learn, the access, the education, you being able to be autonomous or be a part of the conversation of, yes, I'm writing a check, is just so empowering. And you absolutely can invest in funds or, other people that have the track records and have the background. But I just, I challenge you and I ask you to say, well, what more would you learn, or how much more empowered will you feel if you're also making some decisions? You could treat it as play money or, access or community, however you want to do it. But what is money, right? Do we just want it to kind of accumulate and maximize wealth? And is that going to make us happy? No. But can we allocate it to diverse owned businesses, to women-owned businesses that are massively underfunded, and, invest in things that maybe are going to be impactful to the world? How amazing is that? Even if I don't make something on an investment, I'm going to feel really good about it. And again, I'm not saying that I invest just to throw away money, right? That's not what I'm saying. But to be able to have autonomy over, as opposed to just giving it to someone else, there's something really powerful there. You're getting a seat at the table. You're a part of the conversation. And so we're going to dive into and talk a little bit more about what happens logistically with an investment. And this is our typical deal cycle. Any investment group or any investor may have their own cycle, but a lot of the time I'd say it looks somewhat similar to this, which is, first you have to find the deal or the business. Maybe you have brand awareness, maybe you're plugged into different networks as we are, and so we're getting a lot of deal flow. Sometimes I get cold deal flow, off of places like LinkedIn. A lot of times it's garbage, but coming through other investors, high quality deal channels, I look at it. And that sourcing mechanism is giving us basically a huge amount of businesses to say, okay, well, how do we want to allocate? How do we want to invest? Do these align? And the screening process can, again, look very different based on, the type of investor you are, the type of process you have. But we screen for, does this meet the general criteria of something we will invest in? What does that look like? Putting a little bit more detail. We don't want it to be an idea. We want it to de-risk a little bit. They don't need a bunch of revenues, but we want to see some execution. We want to see a founding team who has done this or has real deep industry expertise, grit. They're going to make it work. building a business is really hard. Founding team matters so much. We want to make sure timelines and check sizes and all that align. If it's a team that does not have a woman on the founding team, we're going to talk about culture diversity. Are you adding women to the executive team? Are you adding women to the advisory and or board team? We'll talk about it. Because we don't want to just be another check. We want to make sure we're aligned. We're mission driven, we're investing in something that we can get behind. So assuming that we screen it and we see, we're checking the boxes of this is interesting, it's a good market, there's some kind of traction or good execution, all those things. If that all happens, and if the group members, the investment group is interested, then we'll invite them to one of our pitches. And so we do a quarterly pitch event, or maybe, additional off cycle if something's really interesting and doesn't meet that. But typically a quarterly pitch cycle for us and for many other investment groups. And the pitch is kind of this meet and greet, hear about the business, but also be able to start asking questions and start digging in. You can't learn everything, in a 30-minute call. And we'll typically do maybe 4 pitches, that's 2 hours, but we'll start to learn more about the business. And if there's enough interest out of the pitch, then we're moving into diligence. And diligence is, let's go deeper. We want to see, the actual numbers or, dig in and find the gaps or find the things that are risky that they didn't cover. Is that accurate? Why did this number say that? You can start really digging in and start learning. And so diligence is a huge part of the process, right? Really important. And then if diligence goes well, people basically say, okay, let's do it. Let's invest. Or, you know what? Let's pass. It didn't meet the criteria. There was a business we just ran diligence on. We really liked it, but there were just these flags. Not always red flags. Sometimes they're yellow and then red in retrospect. But I'm actually so proud of us when we say, wait, stop, slow down. Don't just get excited. Right? It's really important. You want to dig in. Okay, we have a question. What kind of things would you look at to further explore within the diligence process? Great question. So there's typically a few things that happen. There's typically a deal room or a data room where it's them sharing documents that might be financials or cash flows or deeper, maybe marketing or product market fit or material where we can learn more about the business. So there's typically this repository, the secure data room where we can get access to more information. We also collectively, because it's different people with different backgrounds, which is great. We'll maybe dig in or we'll start running searches and say, wait, I came up with this other competitor or this thing, answer these questions. And we come up with a question list. And the question list is something that is pretty comprehensive. It might dig into financials. It might dig into, strategy or exit or, any types of questions that come up from our group. And then we'll jump on a call with the founder or, whoever's leading the fundraise, and we'll ask questions. And by the way, a huge part of diligence is how well are they handling and navigating us? Because are they doing a good job with the fundraise? Are they competent? Are they timely? Are they, following up? Because if they're not executing on the fundraise, maybe they're not executing on other things in their business. So there's a lot to learn. We also may be jumping on calls with other investors and or customers or prospects. Again, back channeling, finding out, is this a company we want to get behind? Yes. Okay. And then there's one more, slide I want to share on kind of the deal cycle, which is what happens after you invest? Do you just say goodbye to your money? Kind of, right? Because it's illiquid, meaning it's tied up oftentimes for years, maybe 3, 4, 5 years, maybe even longer. If it's going on a really big journey, to try to grow big. And so understanding that there will likely be other financing events. There will likely be, years of no liquidity. And then if there's a liquidity event, I say if, because there's not always a liquidity event, you could potentially get money out. If not a full sale or acquisition and a full exit, or it could go to zero. And so being aware, right? It's not like I invest and then 2 years later, I want to buy a home and I'm like, oh, I want to use the assets that are on paper. It's just on paper, right? You don't actually have liquidity. on these investments. For the most part, you may be able to get somebody to buy it and it's this whole thing and approval process and transaction, but for the most part, you don't have liquidity. And so, getting back a little bit to why you should think like investors or why you should invest, I've covered some of these topics, but really at the end of the day, right, knowledge and confidence, I mean, it really does upskill you and allow you to operate on a different level within your professional career if you're investing, or if you know the dynamics of investing. It allows you to choose companies or roles more selectively. It allows you to navigate more strategically into bigger equity comp packages. The network and the access, if you're in this community, really opens up doors. You could navigate to a board seat. With us, when we invest and we offer financing, we also say, great, we also have some really great board candidates. Do you want to talk to them about placement within your business? You could, when you write a check or when you're negotiating or looking at a financing round, you could actually agree with them. You know what? I'm really interested in the board role. I'd be happy to be an investor, but I want to be considered, or I want to be on the board. And that could be a part of the check writing. Last point on the slide, power dynamics, right? I already spoke about it a little bit, but having more women in the room. And I spoke to this point a little bit earlier, but as an investor, you are truly getting rewarded. Company equity is great, but it takes a while, typically 4 years to own it. Investments or investors, right? You're getting immediate ownership. You also, as an investor, are on a different platform, a different playing field. So if you have questions, feedback, thoughts, you're operating on a different level. The last point on the slide I like, which is just reminding yourself, right? Building a business, launching a business is extremely hard. If you can allocate capital across different businesses and build a portfolio that's diversified and, be influential or see what's happening among the journey, within your portfolio, it's a lot easier than running a business or, trying and building, different businesses. I can invest in 5 businesses this year. Am I going to start 5 businesses? Hell no, right? And so again, I'm not saying that investing is the path for everyone, but just thinking through, right? What might be the path for you? And how do you get involved? So you as an individual could be an angel. And to the earlier question, right? Do you want to invest at $50,000 or $100,000? Maybe not. That's a lot of money. And if you're building a portfolio, that's really tough. But maybe you want to write checks for 1,000 or 2,500, and then you could do that as a part of a group. You could come together. It's called a syndication or a syndicate. You can invest alongside others, and so you have lower deal minimums, lower investment minimums. And I just have a few, images up on this slide. She's Independent Investments, of course. We love our investment angel group. But then I have up a picture or an image of Carta, which is a place where if you have, company ownership or stock or options, that's one of these companies out there that manages that. It's basically a digital wallet for your ownership with private companies. And then the peace sign is AngelList. And that's another network that's a pretty big ecosystem of private companies. So I'm just mentioning them. We have a question in the chat. It says, do you typically invest in certain industries? Any that are hot for your investments that we can get excited about if we invest through She's Independent? Great question. So we right now don't really have a focus on a specific industry per se. I'd say we're really focused on seed plus, small a. Again, we want the opportunity that if these companies get big, we'll get a big return or a big multiple expansion in terms of where we invest. We have a lot of really great deal flow to answer your question. I'll give you examples. We've made 5 investments so far this year. We're actually closing our 6th, 7th, and yes, 8th. And we just launched in January. And I can give you an idea, walking through some of the investments. So one of the ones that we're actually working to close in the next week, it is a safe for kids Uber concept. By the way, some of the early actual Uber investors are investing in this business. And I don't know about you, but if you watched the Uber docuseries, or, I guess it wasn't really a documentary, but the series on Uber, or if you know anything about that culture, it was not friendly to women. This is a woman-owned business doing tremendous things. She's a single mom. I want to say she drove 800 rides with her kids in the back when she was testing out this concept, and she's tremendous. And I'm somebody from a data background, and I'm like, I like high margin businesses, but guess what? I can get behind Rebecca any day. She's amazing. She has great investors that are helping her tremendously, phenomenal traction, and it's a massive market. So that's one example. Another example is an e-learning company where they focus on K-8. So basically early education, and a really interesting model in terms of how they're creating their content. And they have a play on the metaverse, or think of kind of a virtual space for learning in the future. Another concept. We invested in them earlier. A few direct investments, so not syndications, but it was individuals in the group writing checks, because sometimes that's easier and sometimes it just moves more quickly. There's a company called Predictamed, and they do early autoimmune disease detection using AI, or artificial intelligence. And that's when I invested in. My family has autoimmune issues. And so it was something I was really excited to get behind. A few examples. We have people from all different industries. We actually this week got 2 inbounds, or referrals, I should say, where they were both wine businesses and women-owned. And they both have incredible teams, both have really interesting traction. And what are the chances? 2 wine businesses this week. I mean, we're open to, and we're looking at all kinds of things. In our last pitch event, we had 5 businesses pitch us. 4 of them were women-owned. And we're actually moving forward with three of them as investments. So far this year, there's been more than 20 companies or investment opportunities that people have had access to invest in. Happy to chat more about deal flow, but it's something that I'd say we're doing pretty well with, and it's exciting. So in terms of equity, right? I've already covered some of these points, but basically there's different ways to get it. You don't just have to invest. But if you do want to invest, or if you're interested in investing, I think one of the best ways to do it is alongside others so that you can learn. Lots of things to remember if you are thinking about allocating or you're thinking about investing. And I've said it a few times, but it's really risky. I can't tell you, I'm not your financial advisor. I can't tell you, hey, great, allocate 50 grand this year. But if you do have a financial advisor or somebody that you can work with on this, or again, it could be you sitting down, with yourself or whoever you want to talk to finances with, and basically say, you know what, I'm interested, I'm mission driven, I want to learn, I want to allocate in an intelligent way, to some of these companies. And maybe you want to focus on companies that are a little bit later stage so you can de-risk some, less risk. Great. You want to figure that out. Another point, do not expect returns or liquidity. I don't expect our returns all to go to 0, but I don't want you to say, wow, Natalie earned 20x returns. We're going to get that. That just, you never know, right? I'd be happy with 5x. That's amazing. Negative selection. Thanks for joining, Mon. Great to see you. Negative selection. If you're passively taking inbound deals and you're not doing work proactively, negative selection means they're not going to be great. You need to cultivate, you need to invest in that ecosystem. You need to spend time, find a lot of companies. I don't want to look at 5 companies and invest in one. I want to proactively find 100 companies and invest in 1 or 2 or 3. Negative selection is I'm sitting here passively and whatever comes at me is the only thing I look at. And the final point, which is exciting, right? Expect to learn, expect access, expect opportunity. Maybe returns, but don't expect it, right? And I mean, I started a little bit with my why, and I think it's something just to ask yourself, because at the end of the day, what do you want to get out of this thing? Are you looking for financial freedom or financial success? Okay, but why? What's driving you? Maybe it's the power dynamics, and maybe you didn't get the roles that you wanted professionally, or maybe you're getting towards that place in your career where you say, no, I want to start, doing this on my own terms, and I want to own this path, or I want to get better at, X. And really asking yourself, right, what's your expertise? Because when you show up and you know your expertise, then, oh, I'm gonna lead diligence on this, or I'm gonna be the research expert, or I'm gonna spend time looking for really good companies that went through, this accelerator that are in this category. It's a great way to apply your skill set. So a little bit more about, and I know I shared a little bit about our investment group, but 5 investments so far this year. Again, we're closing 3 more over the coming weeks, but you can see a little bit about them on the slide. A clean energy transformational marketplace. I told you about the K-8 player. Email marketing, automation. I mentioned Predictamed, and then ESG for blockchain. And on average, our syndications were about 60 or 70,000, and some of them might be smaller, some of them might be bigger. But we really care about impact. We really care about that mission-driven nature, right, of the teams and the businesses. And so we're coming to a close. I'd love to see you, and if you have any questions about the group, would love to get some more people involved. As a reminder, you don't need to be accredited to be a part of the group. You could be there to learn. You could be there for education. If you're accredited, you could be an investing member. Otherwise, you can be an investment observer. And so this bit.ly link that I'm going to drop in the chat, which I did not copy ahead of time, bit.ly/intro to angel, it'll bring you to a landing page. So if you click that, it'll remind you with a promo code and a few other things. So we have, over $1 million in capital today across our 40 members. Deal minimums as low as 2,500. We could bring it down to 1,000, if there's interest in that. And you get to really decide on a deal by deal basis if you want to partake. So there's no requirement to invest, even if you're an investing member. I think it's really just about access learning and, getting some more great people involved. So that's all I have for today. Loved the questions throughout, but if there's more, feel free. You can come off of mute. You're welcome to drop them in the chat.
Yes, one quick question. Can you just talk about the membership, like how the tier, like are they tiered? Is it the same amount for everyone?
Yeah, sure.
The investment observer versus someone who's accredited, etc.
Yeah, absolutely. So here, let me pause the share and I'll actually pull up a slide, or not even a slide, but I'll pull up the website. So this is what I'm going to do. I'm going to start screen sharing again. I want to show you as I do this. So let me know can you see the website?
Yes.
Okay. So shesindependent.com. I'm going to go there just to start. And then if you click on get involved, which is this orange button, it brings you to the sign up page. And there's 3 different investment group membership options. The first one is investment club, and this is for an individual. And so that's $850 a year. And in all of these memberships, it includes access to our e-learning series, which basically is a framework around investing. It's some interviews with other investors. It's about 5.5 hours of content. So it's always included, but in your membership, you have access to, again, live deals. You can actually partake and be active or more passive on a deal by deal basis. You could say, hey, I want to lead diligence, and you'll get, something for that. Bye, Sarabi. So that's the investment club for the individual. And then there's a couple membership. So 1,000 a year. Sorry, it says 1,000 a month. I need to update that. It's 1,000 a year, excuse me. And that's so that if you and your partner are making investment decisions together, you can both be a part of it for nominally more than the individual membership. And then the investment observer is only $275 a year. And again, that's if you're not accredited, or if you don't plan to invest and you just want to be a part of the group for learning and access. And so that's a year, you pay for the year up front. And basically the costs, the fees, it's going into things like forming investment vehicles. It's operational. So you're not going to have other fees around investments other than that one-time payment. I will say, I want to correct myself there. There's not going to be fees around creating syndications or group investment vehicles, but we do include a nominal carried interest, or basically call it, because we're doing a lot around operationally deal sourcing, managing, this process, doing a lot of, time intensive work to make sure this is high quality in terms of how we operate and what we're providing. There is going to be a small percentage that comes out of investment returns, but is not charged to members up front. It's something based on how deals return. So as an example, a lot of investment groups are charging 20, 25%, 30% if a deal does really well. Ours is a flat 15%. Compare that to venture investing or indirect investing. And again, they're going to be charging you 20, 30% on high performers, and they're going to be charging you something like a 2% management fee every year. So we don't have any management fees, and it's a more nominal, lower carried interest charge is what it's called on investments.
Got it. And do you also get K1s for these types of investments as well?
Yeah, it's a great question. So typically for the investments, there's not going to be a standard K1 process. There's going to be the first year, there's going to be a process, meaning we invested, there's something that goes out based on that first year of investment. But if it's a safe or if it's an instrument that's not accruing interest, there's only going to be distributions if there's a liquidity event, meaning we'll only prepare necessary documentation if there's a liquidity event or an exit. Does that make sense?
Yes.
Yeah. But by the way, I love that you're asking that question. If you have any accounting backgrounds, we love having, people in the group with different backgrounds, because ultimately, let's just say that you wanted to step up and, hey, I can help manage or do this documentation process, and make it so that we're not paying an external party. We can reward you with a little bit of the carried interest on the deals.
Good to know. I am an accountant.
Love it. I can tell based on you asking. And I was just chatting with my accountant right before this call.
Got it. Okay, great. This sounds very cool.
Great. I hope you'll join us. Where did you hear about us from?
A friend of mine who she just is into startups. She just sent me the link and I said,
I love it.
Let me come and just check it out. And
Love
it was a little challenging getting in because I went through Eventbrite. And I was like, where's the link? And then I realized that I needed to log into Eventbrite in order for the link to unlock. So I almost didn't attend. I'm glad I did. So yeah, this seems really cool.
We tried sending some emails through Eventbrite, but they may have hit spam, but we mentioned the link in there as well. Yeah.
Okay, very cool. Very cool. Yeah, I like it.
Great. Well, let us know if you have any questions. I'll put my email in the chat as well, just so that if anybody has questions, you
I
can follow
didn't
up.
catch the first part of your presentation. Will you be putting the recording up somewhere?
Yes.
Okay.
So I will circulate the recording if you're opted into our emails from the Eventbrite, but you can also just email me and I can get it over to you. Either way.
All right. Sounds good. Thank you.
Thanks, Lisa. Love the questions. I know we're coming up to the hour. Feel free if anybody else wants to come off of mute or drop something in the chat. Thanks, Michael. All right, well, I hope we're going to make some investors out of you. And I know we still have a number of people on, so I'll give it a few more minutes, but don't be shy. Thanks, Carrie. Carrie is in our investment group.
And you said you just created this group in 2022 in January?
Yeah, I started She's Independent in mid 2019, but the actual investment group, we just started in January. So it really, came about pretty organically. I'm in a network of women that have graduated from board certification training, and a lot of them had interest in kind of learning from me based on my background, and really glad I did it. So we're growing based on referrals. I think we'll try to get to PR, but still early on our journey, but doing some great things.
What's PR?
Press release. So basically like paying and working with somebody where they can write some stories and pitch publications.
Got it. I see.
And Dio, you asked a great question. Do you have members that are not already in the finance world? 100% yes. I am probably myself, and then I know one other are, from the financial world. I think otherwise, the other 40 members, they're not from financial backgrounds. Some of them maybe had invested in real estate or, public markets, but a lot of them, it's first time, diving into this kind of stuff. Again, I think it's so important to be learning and working alongside others because, you're going to learn and you're going to make mistakes and, you're going to build confidence over time. And not feeling like you need to know everything, working alongside other smart people. I've seen other investment groups and the caliber of the way we operate and the deal flow, the quality of deal flow we're seeing has blown me away. Okay. And I have an institutional finance background, so I'm really excited about it.
Natalie, this is Althea. I had a quick question.
Yeah.
When you talk about the quality of the deal flow, are you having pitch sessions or monthly or weekly deal flow sessions?
Yeah, great
How
question.
are you working that?
Great question. So we're getting deal flow from many angles, and part of it's that we've cultivated an ecosystem and a network, and we're plugging into different communities. I also have spent, many years in finance myself, and just having a lot of relationships, with other investors and other angel groups is part of it. But the screening and the providing access, let's say, so that other people in the group can be a part of early stages of deals. We don't right now have like a weekly session. We're jumping on one-off calls. We're giving people the option if they want to step into leadership roles or if they want to be involved, let's say in screening or diligence or a lead or whatever capacity or however active somebody wants to be, there's an option for that. And so I think we're actually going to further standardize our process so that it's a little bit more scalable, so that we'll have an intake form so that we can actually start to underwrite or understand what is the basics of the deal. Do we want to jump on the screening call? But right now it's a little bit organic. We get an email, we have an investment kind of screening team where anybody can be a part of it. And we'll jump on, whether it's myself or, one of the other 4 people on that email distribution list, and we'll do that initial screening.
Oh, that sounds good. I'll definitely reach out. I'm in an investment group now, and one of the
Great.
things that I like to do is the due diligence, which most people don't like to do, but I happen
Love
to
that.
like.
Oh, I love that. And listen, the carried interest, meaning we're portioning out a little bit of the returns to award people for doing work. And so if you step in and you're like, I'll do diligence or I'll do some of the accounting, we can actually award you something. And so that if we come together and we're investing $100,000, you will get a small portion, in addition to your investment, where it's this additional exposure for the work you've done. So you get even more upside.
Thank you very much. I've got to run to another meeting, but this was a great call. Thank you.
Oh, thank you. I'm so glad you joined.
Yes, thank you again, Natalie. I'll be in touch.
All right, wonderful. Well, thank you. I know we
Awesome.
still have some others on, so if anyone else has questions, feel free. Thanks. All right, I'm going to end it. Thanks again.